actually talk to you about how to de-risk your business with smart investments. And the idea here is that there are different types of money that we come into when you're running a business. So We Capital is a venture cap investor. So you may raise a lot of money, like say you raise $1 million as part of your fundraising round, but you don't need all that $1 million in day one. So today I'm going to take you through what do you do if you have some capital that's sitting and doing nothing, so you can actually make the most of it. But let's say you're cash flow positive, meaning that you're profitable and you have money sitting in a bank. What else can you do with those kind of funds? And really, it's an interactive session. Feel free to unmute your mic. It's meant to just be a conversation, so happy to take that, and I hope you find the session insightful. So you know a little bit about me. So I'm actually Kenyan. I was born in Kenya, and I actually went to London and studied and worked there for about 20 years. So half my life I've spent in London. And then just before COVID, we got very lucky. We decided to move back to Kenya, my husband and I. And again, I was, like being, at a big corporation, really helping people. I was a bit nervous about what I was going to do. And I'm a little bit lazy. So I was like, what's the quickest way to learn how to start a business? If I'm going to do a lifestyle business or a venture-backed business, it's now. I don't have any kids. And I joined an accelerator program called Antler. I'm sure some of you may have heard of it. They have an office in Nairobi, but they're from the Netherlands. And then it came to light that actually 𝘄𝗶𝘁 was the company I wanted to build because I'm financially literate. I'm able to provide access to global markets to the local Kenya, East Africans. And since then, I've not looked back, and We Capital has supported our vision. So I'm very excited to be here as well. So that's a little bit about me. So today I want to take you through the importance of de-risking your business and why we need to de-risk it. And then secondly, how to do it. So I would like you to take away steps rather than just saying, here's this really great information tool, here's all this education, but then you don't really know how to do it. So I want it to be quite step by step. So I hope you find this useful. Okay, so the reason that we need to think about de-risking our business is because of the one thing known as the rising cost of living. If we look back just before COVID, I don't know which countries everyone is, but African countries as a whole have, and globally, we've experienced an increase in the cost of living. So what do I mean by that? The same $10, because everyone is from different countries, I'll use dollars as an example. The same $10 5 years ago, before COVID happened in 2020 or 2019-ish, would have bought me 5 bananas. If I went to the supermarket. But today, that same $10 will only get me 4 bananas, as an example. And that's because of the concept called inflation. We all are business owners, so we understand the concept. And it just simply means that the price of the things we buy are increasing over time. And inflation was at an all-time high globally in 2022. And there are a lot of things that the US market is doing and the UK and the Europeans are doing to help manage inflation. But as history turns, most countries in Africa have high rates of inflation. Take it from Nigeria. Kenya has an average inflation rate of 7%. So I'm based in Kenya. And the reality is that the more that we continue to go, when you go to the supermarket, things are getting more pricier, but our salaries are not increasing at the same price. And if you're a business owner, the cost of your inputs is going higher, but you can't really increase the price of your product. And that's a really interesting point, actually, because we did this analysis recently and we said, the product that we're providing is solving a pain point. So we recently increased our prices. And I actually thought that our customers would complain, but because they saw the value in what we were providing, we actually had we had 1 or 2 clarifications as to why we increased our pricing, but there was no complaints about it because people feel that we're solving a problem. So if any of you on the call are thinking of increasing your pricing and are a bit scared, I would test it because ours was well received. Another reason that the cost of living is going up, during COVID, there was a shortage of most products because importation to African countries where we're net importers than we are exporters. So there's a lot of women on this call. We all like international skincare products or if you have a baby, you might order a couple of things from abroad. So as a nation, all of us actually import more than we export. And what had happened during COVID is that even movement from China to US or China to Kenya or Africa was limited due to delays. And what happened was there was more demand rather than supply. And as a result of that, people have increased their prices. And once prices go up, it's very unlikely someone will bring down the cost of their goods and service. And of course, because businesses, we're all in business, if the inputs go up, we increase our prices. So then the end consumer is also increasing their prices in order to maintain that profit margin. So as a whole, one of the key things as business owners we need to keep in mind is, if the cost of goods are going up, what can we do? What can we do in other areas of our business in order for us to make sure we're still profitable? And one of the key components is inflation. And just to give you guys like a more of a more tangible example, over a 5-year period, this is globally, the oil prices have increased by 230% or 230 times. And what that means is that oil is used to transport goods, manufacture goods, distribute, whatever you think about it. So when the price of oil goes up, the price naturally goes up. And that's how we've all experienced the impact of increasing prices in any sector that we're using or looking at. The second thing, I know everybody on the call is really familiar with this because we're all in business, and unfortunately, African countries have currency depreciation at the next level. So this is an example of the Naira. The Naira has, over a 5-year period, lost 74% of its value. So let's say you and I are based in Nigeria. 5 years ago, we had 500,000 Naira. Today, that same 500,000 Naira, as a result of you doing nothing, so you've made this, you've gone to work, you've generated revenue of 100,000 Naira or 1,000,000 Naira, and you've saved 500,000 Naira as a profit margin. But what you do is you go and put it in your bank. But because it's sitting in Naira, as a result of you doing nothing, your 500,000 would have lost 74% of its value. Now, this is a very similar story in Kenya as well. Over a 5-year period, we've lost 31% of our value. And what really struggles is that because we all, and some of us have raised from VC money, we're measured in dollars. So last year, our business was growing consistently, but because our Kenya shilling was weakening, it was as if we were standing still. But really, the growth and the efforts and the thought and delivery that went from my team was significant. It just wasn't being communicated in our numbers. And another thing that we did was we started reporting in Kenya shillings to our investors so they could see the actual impact of growth, because unfortunately, out of my control, the Kenya shilling was depreciating. But really, this is a problem, right? We know this is going to continue happening. So why should we really consider this? What can we do to really protect our business growth from factors that are out of our control? And really, by the way, this is stuff that you can actually implement in your personal lives too. And I think as founders, it's very important for us to have thought about our business growth, but also our personal growth. So if you are a founder and you're looking to make your money work for you, let's say you get paid $2,000 a month as a salary, you should be saving and investing $500. And this is the same concept that I'm going to take you through and from a business perspective, but you can use it into your personal life. So the first thing that I would say what you can do, and this is more general, it's got nothing to do, well, it's not directly related to what I'm teaching, but it's a really important step to understand, because naturally at school, we're not taught things that can help us. We're never taught how to budget. We've never taught how to manage our finances. We all come into money and then you spend it. And this can really help you increase how much you're saving and be smarter. So the first thing, of course, as a business, you always budget what you're going to spend that year. And you also track the variance. You have a CFO or an accountant who does that for you. If it's a lifestyle business, it's very likely you do it yourself, which is even better because you've got a pulse on your business. And you create that budget anyways. And so even in your personal lives, you should create a budget. How much do you want to spend on a monthly basis? What is your incoming and outgoing? And then the second step you want to do is to understand what loans you might have, because debt can be great and it was designed to help you grow. But debt can also be detrimental if the interest rate you're paying is much higher than you can grow. And unfortunately, I've lived a long time in London, and I used to I used to get a lot of mortgages there just as investment properties, and the mortgage rates were affordable. It was like designed to help me get onto the property ladder. But in Africa, if I want to go, well, especially in Kenya, if I want to go buy a property today, my mortgage rate is at 21%. Like, that is significantly higher than 2-3% in the UK. And I know it's the same across most African countries. And so not all debt is good debt, and not all debt is bad debt. So you need to identify if you have any short-term loans, any business loans that are on average higher than 12%, that's a bad debt. And the idea is that you always need to pay that off first, because if you're earning to pay your loan back, that's not a really sustainable business. And the second thing is to create an emergency fund. Even with a business, it's important to understand your cash flows, and it's important to understand in a month where you're unable to generate revenue, how much money do you need to run your business? And as as naturally when you're VC backed, you really have a clear indication of what your monthly burn is. And that is when you build an emergency fund, that you always have that much amount of money tucked away in something that's super liquid, but it's still earning interest. So at least for a month or 2 months, you can survive should revenues be stopped, or another COVID example happens, a pandemic happens. And this is very true as well of your personal life. So let's say, your housing expenses, and you're working for someone and you lose your job. You can survive for 2 to 3 months because you've actually built an emergency fund. And the things that you want to invest in when holding an emergency fund is normally a cash fund, so a money market fund or a high interest bank account. And the same goes for a business and or your personal life. Of course, the fourth part that I've touched, you have to invest wisely. And the thing is, you need to diversify your investments. You can't have all your investments in one egg. So meaning you can't have all your money with one bank either. Unfortunately, globally, we've seen some counterparties, which are banks and other institutions, that go under. So if you had all your life savings in a bank, or all your business operations in one bank, that's quite risky. So that's also an interesting part about diversifying investments. Also includes diversifying the partners you work with when it comes to managing your money. And then, of course, the last thing is like looking at ways to increase your income. So today I'm only really going to spend time on step 5, because I want to show you how you can de-risk your business growth by investing smartly. So this is what I would really like to focus my time on, but there's a lot you can really look at on the other steps that can increase your business revenue and your personal household revenue, which I would really consider, because being a digital economy now, there's a lot of things that you can do, and the time put in could be, you only do that for half a morning or 3 hours on a Saturday morning, but the impact or the revenue generation you get is much higher. Okay, so how do you de-risk your business with smart investments? Now, before you can even get into thinking about growing your investing in smart investments, there are a couple of things you need to understand as a business owner. The first thing is risk appetite. So risk appetite simply means how much risk are you willing to take with the money that you have available today to run your business. I think the answer is the same for all business owners. Running a business is risky enough that the money that we've raised from investors or other business partners, and or the profits that we've made, we want to invest them responsibly in products that preserve capital and give you a little bit of return that outperforms inflation. Because the reality about businesses as a whole is that we're impacted by things we can't control, i.e. a pandemic, high rates of inflation, high unemployment, taxes, changing governments, that we don't want to run too much risk in our investment portfolio. And so you want to be a conservative investor. And that simply means that you're looking to grow your money, but enough to outpace inflation. You don't want to be in crypto, as an example, which has a lot of volatility and movement, that you can lose your money. The other thing is to understand, okay, so if I'm looking to make investments, I need to make sure that I don't put all my eggs in one basket. I actually put my eggs in several baskets, so that if one egg cracks, the other eggs remain the same. And in investing, that's known as asset class diversification. And simply put, asset class diversification means holding your money either in a cash fund or a bond or a equity. So the different types of, or real estate. So the three, like those are the four main asset classes when it comes to investing. And as a business owner, equities are quite risky. So I would avoid investing your money in equities. I say they're risky because they're high risk, but they also generate a lot of return. But as a business, given that we run so much risk in day-to-day business, it would be, unless your business is super profitable and you're generating significant amounts of revenue and it's consistent and you know it's consistent, I would look to invest in cash funds, in bonds, and maybe real estate, depending on the type of business you're doing. So if the real estate is an investment into your business, so instead of paying rent, you're actually buying the asset so you can reduce your monthly outflows, then that's a really good investment. The second thing is currency diversification. So the reason we say currency diversification is because of currency depreciation. That's always the tongue twister. And the reality is that if you were in Nigeria, so I have a friend who runs a skincare company and she's also VC backed. And she was telling me that unfortunately, all of her products are either made in China and some of the stuff is made locally in Kenya. And because she is buying the product in dollars, but selling it in Kenya shillings, she's running a lot of currency risk. And unfortunately, with skincare, it's an intangible product. So it's a nice to have rather than a painkiller. So if somebody feels that the price is constantly being increased, you'll lose that customer. So what she started doing was, as soon as she started focusing on currency depreciation, diversification, and as soon as she was getting enough profit or margin, she would change her Kenyan shillings into dollars and invest it in dollars, because she realized that every day that she held the Kenyan shillings, because her product is being manufactured in USD, she's earning in Kenyan shillings, she was losing money every single day. So currency diversification is really important, for all of us actually, because all our businesses are in Africa. And luckily for us, we do a lot of investing and we invest a lot of our revenue in dollars anyways, and we also earn in dollars, but there are moments where we also earn in Kenyan shillings. So that's a really interesting point. So you want to hold a hard currency. And the rule of thumb really here is that you would own 50% of your assets or your income in local currency, depending on the needs of your business as well. And you look to convert 50% of your profits or hold your VC-backed money that you raise in dollars until it's needed. Because so I worked at BlackRock for a very long time. I had access to the most brilliant minds, but even at BlackRock, the currency funds would make the wrong decisions, because currency is something that you just cannot predict no matter how much data you have. And even the portfolio managers used to tell me about currency, as much as we've got all this data, it's a gamble. And so this is a really critical point for us, because we want to navigate the currency depreciation, because we experience it so often. And the last thing is counterparty diversification. So I'm going to tell you a story. I'm sure you all heard in the news that SVB went under. And actually, a lot of startup founders had a lot of money in SVB, which was so Silicon Valley Bank in the United States. And you would think that United States is so heavily regulated that the bank, such a large bank as SVB, wouldn't go under. But actually, what had happened in that situation was the bank itself was doing okay. I think we need to globally change the rules of how much information is published online as an entity. So SVB recorded a loss in their business. And what happened was, because a lot of VC LPs and individuals held money with SVB, they saw this piece of information and they panicked. So there was a bank rush. So everyone was trying to take out their money at the same time. It wasn't that SVB wasn't profitable or they weren't doing the right things. They had just recorded a significant loss, which happens. And that's part of finance. Like, you take some bets, you give out some loans, people default. And it obviously was a little bit more complex than that, but the bank rush caused the bank to go under. So there's this big manic rush, and what happens is, at a bank, they only, let's say they have 100% deposits, they're only required by law at any given time, and these change from country to country, to have 30% of liquidity in the bank. So just imagine you all panic, you hear SVBs have made this huge loss, and then we all run to the bank and say, we want to withdraw our money. And because of that bank rush, essentially the bank goes under because they no longer can provide that much liquidity because they just don't have it. And the way the bank functions is they lend out that money. That's how they make revenue. They invest it. That's how they make revenue. And because there was so much information available on SVB, they actually went under, not because it wasn't a good bank, it's because of the bank rush. And so the learning from that, and I always do this even with our businesses, is that we have 4 different bank accounts, we have 4 different custodians, and we put half of our, or quarter of our wealth in each of those counterparty banks. Because we don't want a situation, and it's happened in Kenya several times. Chase Bank went under, was it Imperial Bank went under, a few other banks went under. So instead of holding all the money that I raised from my VC, because I don't need it today, in one bank, I've split it even in the US, and I've also split it in Kenya. Because yeah, we want to be smart. We don't want to have all our wealth. And this is also for a personal level, by the way. I personally have 5 different bank accounts, and I don't put all my money with one provider, because even in the US, things like this happen. So, you know, it's very likely that in your lifetime, you're going to experience, and you don't want to lose all your wealth because you decided to bank with just one partner. I don't know if there's any questions at any point, please feel free to unmute your mic. So this is all well and good. Like, once you understand, okay, as a business, ideally you should be low risk because you want to have capital growth, but not at the risk of the capital. Second thing is, we know that as a business, we shouldn't invest in equities because it's high risk, but we can invest in cash and bonds. We also, as a business, know, because we're on the African continent, we should have half our wealth in local currency and 50% in USD. And lastly, let's not put all our money with everybody in one bank. Let's move to 2 or 3 different banks. I know it's a little bit annoying, but if you don't, this is what the role of your CFO is. If you don't have a head of finance as CFO, I assume you're the CFO. I was that for a very long time, but it's their jobs to set up this type of governance. And if they're not doing, and you have one, ask them these questions. So really, the best way for a business to diversify or de-risk your business with smart investments is to look at a treasury management solution. So what a treasury management solution allows you to do is, firstly, generate more income or earn a higher yield. And it's not going to be a yield that is higher than the equity market. It's simply going to offer you better yields than a bank so that you can outpace your inflation. And the way that you would do that from a nice, well-designed treasury solution is to invest in assets that give you, that are safe, that protect your capital. And as a result of that, you're generating more income, which means that you're actually extending your runway. So a runway being, you know, how much money you have left to continue growing your business until you figure out how to be profitable. Because you're investing and you're smartly investing, that money can supplement your, for example, for us, we use our money to supplement an end of year retreat for our employees. And during that is when we discuss, you know, what are our goals for the new year. You know, you get to team build, and I don't have to pay for it because my investments actually pay for it, which is great. You can use it to supplement your monthly expenses as well. And just remember, this application is the same for your personal account. You know, if you invest smartly, you can use passive income to pay for your children's school fees. I've done that for my son. If you invest smartly, you can actually pay for the help in your house because you're earning interest on money that you already have, but you just need to make that investment decision. And of course, the most important thing about a treasury management solution is that it needs to be accessible. Let's say that Debbie, you know, was running her business and she had an emergency. The idea is that you want to be able to withdraw your money within 3 days, just in case if something happens and you want to invest. So again, we would never recommend you investing in something that has a 5-year locked period, because, you know, as a result of that, you need to know when you need to be able to access your money. So at Dovu, what we have done, we've actually, we service about 45 businesses now who come to us for treasury management. You sit down with a portfolio manager, they understand your needs, and then we help you invest in smart investments. So the first step is, and this is again applicable to your own very own personal wealth, is do not let your money just sit in a bank. So this example, I've just borrowed one from a webinar that we did. This is about the Kenya shillings. So let's say Debbie has gone to work really, really hard to earn 100,000 shillings, or save 100,000 shillings actually. And what happens is the average industry rate that you get on a savings account in Kenya, so this is all relevant, is 4.2%. And as a result of that, after Debbie's worked really hard, she's held her money or saved her money for a year, that 100,000 goes to 104,000 shillings. And then she has to pay tax. And after that, at the end, she's only really earned 3.5% roughly on her money, because after she's paid tax, that's it. And by just doing a really small change in the way you manage your money, let's say Debbie decided, she had this webinar, she listened to me, she was like, okay, I'm going to go get a money market fund. A money market fund is simply a cash fund that says we're going to invest in cash-like securities or investments, and we're going to outpace inflation. And the idea is they'll hold short-term fixed deposits, which is they'll lock up money with banks who give them a higher interest. They'll buy bonds, government bonds, corporate bonds, and those are the cash-like securities that you can invest in. And in this example, Debbie had she was smart at the beginning of 2024. She said, right, I have 100,000 shillings. I'm going to go invest it in Dobu's money market fund. And here I earn on average 13 to 15%. At the end of the year, after tax, she's actually made 13,000 shillings more, which is 10,000 more. And the thing is about investing, if you make small, smart decisions, every penny goes a long way. So the first thing is both personal and in your businesses. If you have a lot of money just sitting in a bank, I will tell you, so one obviously is to find a cash fund that you trust, a provider that you like, that's generating a decent amount of turn, has good track record. And I can maybe at the end go through what to look for in a right partner as well. It's not on the slides, but remind me, Debbie, I'll do that. But by making a small decision, which if you have a good bank manager or you have someone, or you know a good company to work with, you can earn 10,000 shillings. I know it doesn't feel like a lot, but as you go on, you'll see the impact that we have. The second example is, let's invest your money so that you can generate passive income. And this passive income is relevant to both you as a business as well as you as a personal founder. So so this is called the infrastructure bond ladder, which we created. So essentially in Kenya and in every country, what happens is the government will issue government bonds. A bond simply means that the government is saying to you, Debbie, I want to borrow your money and I would like to give you an interest for that money. I'm looking to borrow the money for 18 years and I will pay you the interest every 6 months. And at the end of the 18 years, I will also give back your money and I'll give you the interest for that month. And so this is something that we've done with a lot of our clients. We've built them a bond infrastructure ladder. So I'll just say that 62,000 shillings, so just the one at the 2018, is about $650. Let's just say that. And what we have done is with clients, assuming that they're investing $10,000 every time a bond has been offered. So this is more illustrative, but this is what we've actually done. So this particular client, let's say Debbie, she invests regularly over time. So 2018, 2019, 2021, 2021 again, 2022, roughly $10,000 as they have grown. And as a result of that, every month in the year, they're getting about 600, and it varies because the interest rate is different, but they're getting anywhere from $600 to $700 a month as a result of creating this bond ladder. And the purpose of this slide, is to show that if you create bonds, if you invest in bonds, even for your business, you can start, for money just sitting there lying around, you can actually start earning $700. So the way I like to look at this is that if I'm earning $700, that means I can pay 5 employees that are slightly junior a month, because their salaries are anywhere. So we do consulting and they invoice us, but it takes the burden off me having to generate revenue and actually being able to pay that. So in this example, Debbie would earn January $600, then in February, because she invested in another bond, another $650, March $650. And also just apply this to your normal life. Like if you had been smart and invested or not smart, if you had the knowledge and invested in a bond that can help you create that, it can pay for your rent. And that's exactly what I've done with my portfolio, personal portfolio as well as the company funds, is find interesting ways to create passive income that is low risk. Of course, bonds are low risk. And another beauty about the government bonds, they're not taxed. So everything that you earn goes into your pocket. And this has been really popular with our users on the platform. And I would really urge you, whether you're in Ghana, Nigeria, depending on how much you trust the government bonds there, and how if they've never defaulted in a long period of time and they have really good rates of return, this is a really great way to generate income. Okay, so now I want to talk to you about, okay, so you've understood that the importance of diversifying your business growth, because there are things that are out of our control we can't manage, because we just don't know what's going to happen. I've talked to you about a cash fund, which is readily available in the market, but these are the funds that you can actually really earn from, either if you go to your bank. So they're called fixed return products. They're simply a fixed deposit at a bank. So these products are typically locked. And what we have done with 𝗄𝗶 is, because we're really focused on making sure our customer funds are in USD, because I mentioned 50% should be held in USD and 50% in local currency, we went and we negotiate with our bank partners a high rate of return. So this is one of the products that we launched. And because we're pooling a lot of funds, we're able to negotiate higher rates. So at the beginning of the year, if you wanted to lock in $2,000, $5,000, and as an example, as a business, you would earn 5.4% on the dollar. And that's really exciting because firstly, you're protecting yourself from any currency depreciation that could happen. So let's say last year, our currency in Kenya depreciated by 20%. Not only have you locked in that 20%, but you're also earning 5.5% roughly on the dollar. So this is a really good product. It's low risk. You can go directly to your bank. You can negotiate with them a fixed deposit. You can work with us, or you can find another provider that also does that. Another really interesting product is to look for corporate bonds that are available in the market. So for example, this is a USD-based corporate bond. It's from a company that's quite well known. They're listed on the stock exchange in Kenya, and actually several other African countries. And it offers you 8.5% on USD. But of course, for example, with corporate bonds, the minimums are a little bit higher. So let's say that if you were to come to 𝗄𝗶 and say, listen, I've raised $1 million from VC. In the next 3 years, I only need 300,000. And the rest I don't need. We'd sit down and say, okay, wonderful. With the others, let's help you generate at least $2,000 passive income. And so one really good example we would do is look at this bond that gives you 8.5%. And I'd say, okay, it's a great way to invest. If you invested 100,000 into this bond, in that year, you would earn $8,500 as a result of just, rather than your money sitting in a bank, you're actually earning. And the beauty with 𝗄𝗶 is that we actually focus on picking the right providers so that you are not taking risk. And I guess if you work with banks or any of the investment providers, they do the same for you. And that really is very important when it comes to picking your provider that you're going to work with, because you want to make sure they've done their homework. Another really great example is short-term commercial paper. This is really exciting because you can hold the money for 121 days, 180, half a year, a full year, 1.5 years, and you get really high rates of interest. Again, this is in USD, and the minimum is much lower. So these are the types of products that you can use in order to extend your runway and earn a high yield. And then, of course, let's say that you think that in your business, actually, that 100,000 from that 1 million, you're willing to take a little bit more risk, and you don't actually need the money today, or this is from your profits, not necessarily the money that you've raised. You're saying, okay, I want my profits that I've made. I have a profit of $40,000. I'm not reinvesting it into my business. I'm keeping it as a future growth. You can actually invested in a smart way in a fund rather than buying individual stocks such as Visa, Apple, or PayPal. I'm just going to buy the technology fund, which last year performed 52% on the dollar. So I obviously have investments in this fund on a personal level, not from a business perspective. So just personal at the moment, because we don't have enough. We're still becoming profitable. So at the moment, I've put everything in more low risk funds. And essentially my personal money has grown by 52% last year by simply making a decision of saying, I'm not going to stock pick, which is super risky, by saying, I know that Visa is going to be around for 15 years. I don't really know. Historically, Nokia was a really big brand, but they're not gone under, but they're no longer market leaders. But actually, I believe in the technology sector, and I can comfortably say that in 15 years' time, the tech will continue booming, growing, innovating, distributing, and people will continue consuming all of tech, that I can put my money in here and sleep at night. And it goes to show that in a year last year where we had high unemployment, high inflation globally, the macroeconomic was high taxes from governments, etc. It still continued to perform really well because tech has become a need rather than a nice to have. So this is a really great portfolio personally, and of course, if you're generating money. And another fund that I'm quite excited about and still remains excited about is the microchip fund. So this holds companies that actually generate microchips. And as you know, we're all moving to smart technologies, so smart fridges, smart cars, phones, laptops, and microchips go into building all of these products. And so it's a semiconductor fund, and I'm very bullish that this fund will continue to grow. And last year, when things were really tough, it did 73% as an example. So these funds are very interesting to hold on a personal level, I would say. But if you as a business are cash flow generative and you have money that you don't need, then this is an equity portfolio that I would then advise you as a financial advisor. But really, this is what I wanted. I want to end on. Let me check. Is that, yeah, that's what I want to end on. Now, this is a really, is an eye-opener really on the small decisions you can make with your money, whether it's personal or your company money. So let's just take an example. Debbie has made $100,000 in profit and over a 5-year period. And 5 years ago, she decided to start holding it in a bank. On average, bank rates globally for dollars are about 3%. They've come up a little bit now. They're probably at 4%. After 5 years, Debbie would have earned $15,000 on her $100,000 hard-earned money. But let's say Debbie decided, actually, very early on, I got some education, I should do a treasury management solution. I'm actually going to give it to Dogu or any other company that provides treasury management solution. And they offered me that bond that was giving me 8.5% as a result of giving them $100,000. Her capital after the 5-year period would be at $150,000. So you're leaving about $35,000 on the table by simply not thinking about how you should be managing your money. So and I think that's what we forget, right? We think that, oh yeah, we're making money, we're saving money, we're making money, yay, wonderful. But as a result of not taking that step further and saying, what else can I do with my money? You actually leave a lot of money on the table. I hope that sort of resonates. That was the end of my presentation, and I can see that there are some comments in the chat. But I think it's important to unmute our mic and ask any question, because I'm here to help. Anything, whether it's money related, finance, how do you think about your cutting costs, anything, because I'm a founder, so I've done it. So yeah, anything that I can help with. So feel free to either put it in the chat. I'm just having a look. So Claire's saying, I've been investing in government securities personally, but I hadn't thought about it as a business idea. Exactly. I think it's things like this that you don't really think about. So the question is, the tech fund, what is the minimum? So the minimum is $50, Katrina. That's how much you can invest and get started. To be honest, we target middle income to high net worth individuals who start with about $1,500. But honestly, I wish I knew this information earlier. Well, I did when I was younger, but when I worked at BlackRock, I couldn't invest in a lot because of Chinese walls, and I had a lot of access to information. And honestly, I started, so I left BlackRock properly in 2019, and it's only been 5 years, and I wish I had started when I was working. I did start, but I couldn't do individual stocks and things like that, but my portfolios have grown significant. Yes, you can definitely invest in these funds if you're from Nigeria. So you simply download the app from the website, 𝗄𝗶𝘁𝗵. And oh yeah, I was going to talk about actually, because there's no questions, I was going to talk about how do you pick the right provider for you. I think this is really important, ladies, because we want to make sure that your money is kept safe at all times. Okay, so first and foremost, one really good way to know whether the provider is doing what they're saying on the tin and they're thinking about keeping your money safe is that, are they regulated? So Dove is regulated by the Capital Markets Authority of Kenya, but we also are regulated by the FCA and the FINRA in the States. So when you invest in the tech fund, we're working with the regulators, and there are actually protections that say, should a company go under, your capital wealth up to $75,000 is protected, which is really important to know. And a lot of people just don't know, have this information. So whichever provider you're looking to work with, this is whether you're looking for a banking partner, an investment partner, a loan provider, you should do your due diligence to understand, are they regulated? Because at least that gives you some level of confidence that they're doing the right thing internally. But one of the biggest questions to ask, and this is also with banks, an investment provider, a lender, is where does your money sit? So this is a flow diagram. So this is how it works. Let's say Debbie decided that today she wanted to work with Dovu. She'd say, hey, listen, I have $50,000 and I want to invest in the bond that you showed me. And the really important thing of how the money should flow is, does the institution work with a custodian bank, which it basically is a party that custodies Debbie's $50,000, who she said to Dovu, please invest for me. So the money doesn't sit with Dovu's operations, it sits with the custody bank. So this is with anybody that you work with. That what would happen is Debbie would say, thanks, Radhika, I want to invest in the RA International. She transfers money to Dovu's custodian bank, and Dovu simply gives an instruction to the custodian bank to say, Debbie wants to buy the RA International bond that I showed you earlier. And the custodian will say, that's wonderful. We tell a broker to go buy the asset. And then the custodian bank moves the money that she gave me to the individual that needs the money and holds the asset under Debbie's name. That is very critical. So in an event that like Dovu is no longer around, something happens, SVB is not around, something happens, investment companies have gone under, the regulator and the custodian bank will get in touch with Debbie and say, hey, listen, we have 50,000 worth of your units here. What do you want to do? Do you want to sell it? Do you want to move it to another provider? If any partner is unable to explain the simple flow of money, I would be careful, because that means they probably just don't have the right governance in place. So obviously I've leveraged my experience at BlackRock and Deloitte to say, how does global standards work? Who do we want to work with? We also have several custodian banks, because that's also a risk that I mentioned. Remember, you want to have several banks that you work with, not one, because it's a risk that you run, unfortunately. So it's just being smart in the way that you manage your money.